This is the Punk Capitalist channel, where grown-up punks say F the world but are matured enough to know that we want to be wealthy so that we can scream it even louder. My anarchy tattoo has been covered up with something more decent. The embarrassment of having that tattoo emblazoned on my forearm almost killed me in the early 2000s. A wise punk capitalist said, "Tell me where I'm going to die so I'll never go there." That there is the key to wealth accumulation success. There are no original ideas on this channel, only ideas from iconoclastic investors whose wisdom can hopefully bring us to the promised land. Every punk capitalist knows that an investment is a bet on the future, one that has an assurance of principal and an adequate return. Everything else can be considered speculation. Great investing requires both generating returns and recognizing risk. Recognizing risk and avoiding losses is the main characteristic of an investor. Punks look out for the downside and let the upside take care of itself. A wrinkly punk put it across this way: if I buy something cheap enough, something good will happen. Risk is mostly found in high asset prices. What is strange in the belief of our suit-wearing capitalist is that as they see the price of an asset rise, they pile into the asset, pushing prices higher and higher. Yes, the price has gone up since the suit bought it. Does that make the suit correct? Has the suit really assessed the risk correctly? Or does he hope to make money from sentiment and momentum? Every punk knows that sharply rising prices imply a greater chance of loss rather than the potential rewards they promise. Low risk and high returns are two sides of the same coin. Imagine a punk going into the thrift store and finding an awesome electric guitar that was selling for $10, and you think it is worth at least $100. Some loon sees the guitar too and offers $70 for it. Now you are thinking of offering $80 for it, hoping to sell it for $100. Any punk capitalist can see that when the guitar was $10, your risk was lower and your returns would have been higher. The punk capitalist lets the loon have it for $70. Turns out the guitar was only worth $50. The punk's valuation was off the mark. The punk's poor assessment of value can be due to poor data, faulty analysis, or optimism. All too human. Had the punk managed to buy the guitar for $10, his money would have quintupled. He would have lost money if he was an emo punk and outbid the loon. Emo punks are suckers and succumb to FOMO and follow the herd. Investment risk comes primarily from too high prices. Too high prices come from excessive optimism and not enough skepticism and risk aversion. It begs the question, what rational justifications do emo punks, loons, and suit-wearing capitalists have to push prices up? The federal interest rate sets the floor for returns. In other words, these are risk-free returns. This is the return we get on our money if no risk is assumed. In a functioning market, all other risk and returns are benchmarked against the risk-free rate. If the risk-free rate is low, the prospective returns of other risky asset classes become lower. A downward shift of the yield curve. If the one-year risk-free rate is 2%, then a one-year corporate bond may require 3.5% due to the additional credit risk of the company. Stocks will require a higher rate than the corporate bond, and so on across asset classes. This is one reason, though not the only reason, why interest rates are closely watched by the market and why asset prices are so reactive to changes in rates. Other times there will be good performing sectors or assets in the market which attracts more capital, which pushes prices up. Sometimes there is just too much damned money in the market with nowhere to go. This all leads to a richening of the market and elevates price-earning ratios, narrow credit spreads, and encourage greed and undisciplined investor behavior. This in essence means that everyone gets less bang for their buck. When too much money is chasing too few assets, people will buy anything at any price as long as it comes with a good story. Think of NFTs, crypto, and meme stocks. Sure, money was made by a disproportionate few, but in this video we are looking at risk and not returns. Risk is not something that can be accurately measured because risk is the things that we fail to consider. It is very scary for the punk capitalist when every YouTuber is shouting that their high-priced assets are going to the moon. I use the term asset here very loosely. Punk capitalists know that the market is not a static arena where the punk can operate. It is responsive and shaped by the behavior of emo punks, loons, suits, and also punk capitalists. While emos, loons, and suits are chasing the market, the punk has no choice but to wait patiently for the right risk-reward opportunities to present themselves. Increasing confidence and higher prices in the market creates more worry for punk capitalists. Remember, the higher the price, the higher the investment risk. On the other hand, fear and risk aversion combined with a larger risk premium reduces risk and increases return for the punk. I will repeat that in another way. When prices fall due to sentiment and the intrinsic value of the company has not actually changed by much, the punk's risk is lowered and potential returns have increased. The punk sees opportunity when the price of an asset is lower. than its intrinsic value. When the market believes something is risky, the loon's unwillingness to buy usually reduces the asset's price to a point where it's not risky at all. Broadly negative opinion can make an asset very low risk because all optimism has been driven out of the price. This paradox in the market exists because most investors think quality, as opposed to price, is the final determinant of risk. But quality assets can be risky and low-quality assets can be safe. Google can be considered a safe investment at one price and highly risky at an inflated price despite its high quality. It's all a matter of price paid and the value the asset promises to bring. Remember, all investing is value investing. It is the art of knowing that you are getting more than what you paid for. Please like, share, comment, and subscribe if you are a punk capitalist.